While most investors cheered the apparent thaw in US-China trade talks last November, there's a critical development nobody is talking about. China lifted restrictions on several key metals, rare earths, gallium, germanium, but quietly kept one vital resource on lockdown: silver. And here's the kicker: they've set January 1st, 2026 as the moment when this control becomes absolute. That's just 3 weeks away. Let me explain why this is not just another trade restriction. It's a calculated move designed to choke the US market at the start of the new year. Think back to the Busan meetings last month. Trump met Xi Jinping. Headlines celebrated concessions on critical minerals. Wall Street cheered. Reuters reported that China would ease export controls on rare earths, gallium, germanium, even antimony. On the surface, it looked like a win for Western buyers. But there was one glaring exception: the one metal that powers solar panels, EVs, medical devices, and countless technologies: silver. Right now, silver trades around $62 per ounce, up more than 115% since January 2025. A dramatic surge, but not a speculative rally. This is positioning ahead of a looming supply shock that most analysts haven't even noticed. Consider October 2024. China exported a record 660 tons of silver in a single month. Where did it go? Vaults in London, COMEX warehouses in New York, Swiss refineries processing silver for Western buyers. It looked like normal trade, but in reality, it was strategic front-loading. Exporters were moving every ounce they could before the January 1st rules take effect. Like catching the last flights out before an airport shuts down. China didn't outright ban silver exports. Instead, they implemented a licensing system that transfers control from the open market directly to Beijing. Starting January 1st, only companies producing at least 80 tons annually can apply for state-approved export licenses. Fewer than 20 companies in China meet this threshold, and all are state-aligned. Private exporters, out. Small independent miners, out. For us buyers, this changes the game. If you manufacture solar panels or electronics, you no longer negotiate with the market. You negotiate with Beijing-approved exporters. Why January 1st? It's clever timing. First, it follows the November trade talks. China gave headline-grabbing concessions on other minerals. The distraction kept everyone focused on the gains, while silver remained controlled. Second, it coincides with the US manufacturing calendar. Companies finalize Q1 supply contracts in mid-December. But the approved Chinese exporters list won't be public until late December, leaving buyers scrambling. Third, Shanghai inventories are at decade lows. Only 780 tons left, versus 2,400 tons in 2019. China is prioritizing domestic manufacturers over Western demand. The U.S. Geological Survey recognized the risk, adding silver to its official critical minerals list in November 2025. Their language was telling: vulnerable to disruption. In other words, the U.S. officially admits it has a silver dependency problem, and China knows it. Let's look at the numbers. Shanghai Futures Exchange holds 780 tons of registered silver, lowest in a decade. China's domestic industrial demand is 5,200 tons annually. Solar alone consumes 3,500 tons. Electronics, batteries, medical devices, water purification, every sector needs silver. Domestic mine production is only 3,600 tons. That's a 1,600 ton shortfall, filled with imports and recycling. But once export restrictions kick in, that gap becomes someone else's problem. The U.S. MOFCOM announcement number 68, issued October 30, 2025, sets the rules. 80 plus tons annual production, 200 million RMB credit line, full ISO certifications, documented export history 2022 to 2024. The final list, published late December, locks in 20 OSO state-approved exporters for 2 years. Beijing can tighten or loosen control simply by changing who makes the list. It's an invisible monopoly. Paper prices don't tell the full story. In March 2025, silver lease rates in London spiked to 15%, normally near zero. By September, rates hit 30x normal levels. Banks couldn't source leasable silver. Refineries rationed allocations. Freely circulating silver now sits below 4,000 tons globally, down from 15,000 plus tons in normal conditions. This is smart positioning by institutional buyers. Vaulting metal now, anticipating January 1st supply constraints. Compare this to 2010 rare earth restrictions. China controlled 97% of supply. Export controls caused neodymium prices to soar 500% plus, dysprosium 2,000% plus. Western manufacturers faced a 5-year scramble. Silver is even trickier. No quick mine restart exists. Largest producers outside China: Mexico, Peru, Chile, Poland can't ramp fast enough. Lead time for new mines, 7 to 10 years. Plus, silver is consumed in industrial processes, often irreversibly, unlike rare earths which can be recycled. Global demand in 2025, approximately 1.2 billion ounces. Industrial and 750 MAOs. Investment, 200 meters ounces. Jewelry, 180 meters ounces. Silverware, 70 meters ounces. Global mine supply, 985 meters ounces. Recycling, 175 meters ounces. Deficit, 40 Oz. Before Chinese restrictions, China exports 135 meters Oz annually. If licensing cuts exports by 30%, that removes 40 meters ounces more. Total shortage 80 meters ounces, approximately 7% of global demand. No immediate replacement. How does the market rebalance? 3 ways. Demand destruction, recycling, mining acceleration. Current price, $62 Oz. Analysts predict $65 to $68. Conservative gold-silver ratio, 67.96. Historically, during shortages, ratio compresses. Silver could easily hit $70 to $75 per ounces by Q2 2026. Timeline, December 31, 2025. Current export rules expire. Last shipments under open market. Gen Sato. 2026. New state licensing system in effect. Only approved exporters can ship. Late December. Final exporters list published. Jan 15, 2026. US manufacturers finalize Q1 contracts. First shipments under new system, likely delayed 2 to 3 weeks, creating an immediate 30 to 45-day supply gap. Expect premiums for Mexican, Peruvian, Chilean, silver, regional price dislocations likely. NY silver could trade $3 to $5 higher than London. If you hold silver at $62, you're ahead of the market before the full impact hits. January 1st isn't speculation, it's documented policy. Supply math is verifiable. Short-term volatility may occur, but the structural setup remains. China restricts supply. Industrial demand grows. No alternatives can replace lost exports. Unlike rare earths, the U.S. can't ramp domestic silver production. Only 2.5% of global supply comes from the U.S. Doubling production overnight? Impossible. January 1, 2026 is the date that control begins. Not just a new calendar year. It's the precise moment China formalizes control over a metal modern society cannot function without. Prices will rise. The only question? Are you positioned for what comes next? Drop a comment with your silver target for Q1 2026. Thanks for watching.